Welcome back to Power Lunch. The S&P 500 hit a record high again today, earlier on, following its 41st record close of the year last night. But don't get too comfortable. Stocks are lower this session now, but our next guest is also expecting an S&P correction to the low 5,000s by the fourth quarter, or about a 10% drop from here. Let's bring in Stifel chief equity strategist Barry Bannister. Barry, don't pop our balloons. Everyone's saying it's going to look kind of good into year end. Why don't you think so?
Well, there's a lot of enthusiasm right now. There's no question. A number of the economic indicators, some of the conference board readings, such as present conditions versus expectations of conditions, the weakness in the breadth of the non-farm payrolls, what's called a diffusion index, the jobs plentiful versus hard to get heading down, meaning we've eroded some of that excess supply on labor demand, and a bottoming out of unit labor costs. This is going to affect upside for inflation. When you add it all together, it's a slowing economy, particularly on the job side. There's a lot of optimism out there, and the market's expensive. So we would certainly urge caution going into the late third and then fourth quarter.
So if I could translate, tell me if I've gotten this right. You think we're going to have headlines about a labor slowdown, headlines about maybe sticky wages or some sort of lingering inflationary pressures that perhaps constrain the Fed of being able to deliver the now half point or 75 basis points of cuts that are priced into the market. Have I got that right?
Yeah, if you look at futures, December 2025 Fed funds futures, they're slightly below 3%. Well, it's very hard to justify getting below 3% without a slowdown. And if we don't have any slowdown, if we continue to utilize these limited resources that we have, then what you would end up is a no landing scenario where rates and yields should not be dramatically lower. So I don't have any problem with the views of and I haven't had a problem with views of the Fed being more dovish in 2024. It's what people expect in 2025 that started to be priced in, and the 31% year-to-year gain in the S&P 500, everything just feels very frothy.
So you've got, you say, a near three-generation high in the S&P 500 PE, and the growth versus value relative outperformance sounds, but has never been higher, I guess. And that has always presaged a recession and a bear market.
Mm-hmm. Well, we look at the growth rate of growth relative to value. So you take the growth index with dividends and you divide it by the value index, and that's just growth relative to value. Then we do the growth rate of that index. And that way you can calculate how much the growth managers have walloped the value managers in the last 10 years. 10-year compounded, they beat them by over 7%. They outperformed them by 100% at a 7 CAGR, compound annual growth rate. It's been miserable if you were a value portfolio manager for the past 10, 12 years. However, since that financial crisis low in 2009 to now, you've gotten in line with growth versus value to where you were in late 99, early 2000. I was there, you were there. Not as many people were in this business 25 years ago when we were at these levels. And we know what a prolonged bull market looks like. We've had one. It lasted about as long as the one off the Reagan years into 1999, 2000, and trees don't grow to the sky. So when we look at valuation, we look at all the things that we do. We're very quantitative and we're very pictorial.
Yeah.
We show this market is expensive.
Barry, the thing that to me is more worrisome, as much I don't want a near-term correction, but do you believe we're expected to see lower forward returns over literally another decade or two? We've heard, and maybe I haven't been doing it 25 years, but I've heard a lot about lower returns in the future that have never yet panned out. Do you think this time is going to be different?
Well, as long as I do this, I mean, I'm almost 40 years now, so it's kind of getting a little bit old and tedious. But the thing I would say about it is that we're looking at about 6% returns for the 10 years ended 2035. We get there through various measures, such as equity risk premium, which would take a long time to explain. What's easier to explain is that the price earnings ratio now in the mid-20s will drop on trailing earnings to about 18 times. The earnings will comfortably double. They've comfortably doubled every 10 years for decades, and there's nothing that we see that wouldn't lead to another double. So double the earnings, take the multiple down. You're looking at about a 6% return for 10 years, including dividends reinvested. So price only, maybe 4. That's not going to make a lot of baby boomers and post-baby boomers retirement plans whole. So enjoy this while it lasted, but investing is about to get a lot more difficult.
I don't know. Maybe the multiple is going to be, if the multiple's okay because, we're the best, horse in the global markets and the companies are going to get more productive thanks to AI. I don't know if I want to say multiple expansion, but maybe it hangs in there.
Yeah, well, there's no doubt that the AI, which is, I think, this is apostasy, but I think it's more evolutionary than revolutionary.
Sure.
It's just a better way to use the data we already had on the internet. The internet was revolutionary. Fiber optics and telecom was revolutionary. And so I think this is evolutionary. It's been hyped up. I don't think it lends itself to the monopolies that allow the enormous returns, both cash and earnings in tech companies. In other words, having an AI position is probably better for society than it is for a monopolist like social media Meta or search Alphabet, Google. So it's going to be interesting to watch this general purpose technology develop. But so far, to me, it just looks evolutionary.
Now you're making us all feel scared again. It's not Halloween yet. Barry, thanks for joining us, though, to break it down. Appreciate your time.